We are recording this event, so that you and other people can watch it afterwards. I'm Jim Hamilton, Professor of Economics at UCSD and Chair of the Roundtable Steering Committee. The feedback we've been getting on this online venue has been pretty positive. So we're planning, at least for the first half of 2021, to continue with the Roundtable as an online series. And we do appreciate your feedback on how that's working logistically. One of the comments we got is that some of you missed the opportunity to chat with each other in small groups after the main session. So one of the things we'll be trying today is at the end of the main event, you'll be invited to join a small breakout room. All you have to do is click on that and you'll be put in with a smaller group. Some people you may know and some people you may not know, just the same as in the live event. And as with all things, please give us feedback on how this is working for you, as it's a learning process for all of us to figure out how to keep moving forward in these challenging times. Let me take this opportunity also to thank our steering committee, Don Billings, Jeff Lewin, Joe Marshall, Terry Moore, Alan Nevin, John Reese, Vanessa Violitzko, and Manny Labrinos. And I'd also like to take this opportunity to thank our sponsor, corporate sponsor, the CFA Society, who makes this program possible, and also our table sponsors, California Western School of Law, Terry Moore, Reese Investment Management, Solon Hill, Lewin, Rez, and Engel, and Xpera Group. And now for today's speaker. Darrell Duffie is one of the world's premier financial economists. He's been president of the American Finance Association. He's a winner of the Ross Prize, the Graham and Dodd Award, the Smith-Breeden Prize. I could go on quite a bit. He's the author of many influential books and articles, some of which got him those prizes. I'll just mention his beautiful textbook, Dynamic Asset Pricing Theory, which is where a lot of the world's finance PhDs got their training. Just reading his official title, I need a big breath, but let me try it once. He is the Adams Distinguished Professor of Management and Professor of Finance at Stanford's Graduate Business School and Professor of Economics by courtesy appointment, which I think means the economics department would like to claim him too, but he mostly teaches in the business school. Like the hero of the old comic books, he's decided to use his powers for good. And he spent a lot of time in recent years thinking about the nuts and bolts of how the financial system works, plumbing of the financial markets, if you will. And he's been very persuasive in arguing that not paying enough attention to the plumbing was a big part of how we got into trouble in 2007 and 2008. And he's going to be talking today about a market you might have thought was boring and stable and nothing to worry about there, which is the market for US Treasuries. But that might be another case where if we don't pay attention to the plumbing, we might find it a more exciting market than we're used to. Please join me in welcoming Stanford Professor Darrell Duffie.
Jim, I just want to thank you very, very much for inviting me to this forum. I see some people that I know and some people that I don't know in your audience, and I'm hoping we're going to have a really engaging hour together. I know we have a limited amount of time, and I'm actually more interested in your reactions. You're one of the premier macroeconomists and experts on bond markets of our generation, and I want to hear about the views of others present, many of whom I know, and I'm sure we'll have some views. And so I would like to keep this as engaging as possible. Feel free, please, to interrupt me with questions as you see them come in. I'd be happy to engage along the way. And then, of course, we're going to leave a liberal amount of time after my initial remarks to have a discussion. My subject, as you hinted, is the US market for treasuries, the secondary market in which treasury securities are traded. On the news in early March of this year of the COVID pandemic, it was quickly realized that this would have a huge macroeconomic impact on the US. And that affected the treasury market in two ways. Number one, of course, the US government would have to borrow an enormous amount of money to get through this crisis and for a long time. Number two, the economy was turned upside down. Basically, jobs were lost. Both the supply and demand shocks were enormous. It's turning out, as we know now, a little bit better than what financial markets reflected at the middle of March. But a third problem showed up in the Treasury market, and that was the dysfunctionality of that market. It could not handle the demands for liquidity of investors around the world who wanted to cash in their Treasury securities for cash. It was impossible to intermediate that market for reasons that I will explain, or essentially the structure of the secondary market for Treasuries. The heavily bank dealer dependent intermediation of that market.
Sorry, somebody's muted.
I was unmuted. I got muted again. I don't know how that happened. I don't know how much of what I just said was lost, but I'm going to walk through what happened in the U.S. Treasury market in March using some slides as a demonstrative. So I'm going to share screen. Okay. If anybody has a sound or video issue, just let me know. So basically, let me review quickly what happened and then try to diagnose the problem, and then talk about changes in the structure of the market for Treasuries that will make it possible for this market to continue to function properly in the future. So first, as I mentioned, in March of this year, COVID news triggered a dash for cash around the world. Well, investors in Treasuries liquidated their positions or attempted to, but the demands for sale of Treasuries were so large that they choked the balance sheets of the bank-affiliated dealers that intermediate the lion's share of this market. Almost every trade by an investor in Treasury securities must be purchased by a large bank-affiliated dealer and sold by a large bank-affiliated dealer. Smaller dealers are numerous, but they don't handle a large flow. And those balance sheets are constrained in terms of how much flow they can handle. Those dealer balance sheets are limited by post-GFC, post-Great Financial Crisis capital regulations. So the bond market choked. Central banks responded, particularly the Fed, quickly and in large volume. In an unprecedented market action, the Fed purchased $1 trillion of Treasuries in just 3 weeks and put in place a plan to buy $3.2 trillion in bond purchases in the Treasury and agency MBS market this year, which is 15% of GDP. That's enormous. And that's not counting any of the Fed emergency programs. This is just Fed supplying liquidity to bond markets. This is not quantitative easing. This is not normal monetary policy. Chairman Powell said the Treasury market is illiquid. The Fed needs to contribute liquidity. That was in a famous March 15th press conference. The ECB and the Bank of England followed with very large bond purchase programs of their own because their security markets were also choked with demand for liquidity. But normally in a financial or macroeconomic crisis, we expect the US Treasury market to be a safe haven. And this March, that didn't work. Yields were extremely volatile. In just a 2-day period, March 17 and 18, if you had owned a 30-year Treasury bond, you would have lost 10% of your market value. So the US Treasury securities were not a safe haven. as normal. Even at the worst of the great financial crisis of 2008, Treasury securities were, the market was liquid and Treasury yields dropped, improving the position of the owners of Treasury securities. Here is a profile of the purchases by the Fed starting in the middle of March. 280 billion the first week, then over 350 billion the second week, and over 330 billion the third week. And then the Fed continued to purchase significantly through, and it continues to do that through today. Massive response by the Fed. The Fed did what it was supposed to do, but we shouldn't be relying on the Fed to rescue the market if the problem is that the market structure is unable to handle surges in flows. So let me review quickly the market structure for US Treasuries. And again, I'm happy to take any questions along the way, and I'm getting ready for, get your questions ready for afterwards. So this is a schematic diagram just illustrating the idea of what you would do if you're one of the blue dot investors in this diagram. You are a customer of a dealer. If you want to sell treasuries, you can contact a dealer and ask for quotes. Or you can launch a request for quote to a dealer or more than one dealer on a multilateral trade platform. None of the blue dots can trade with each other. And all of the blue dot transactions are settled with dealers. That bilateral market structure was the root cause of the problem in March with the functionality of the US Treasury market. The dealers themselves have a relatively more efficient interdealer market structure where they can trade the most recently issued treasuries at a central limit order book, the largest of which is BrokerTec, and they can trade bilaterally with each other. But the blue dots don't get to trade in that more efficient intertier market. I'm going to spend more time on this slide than any other because I think it's, although very rough and crude, it's the best illustration of the problem as I diagnose it. By the way, I was asked to look into this by the Brookings Institution. And when I investigated the problems in March, it was pretty quickly apparent this was the main problem. This time series, as you can see on the horizontal axis, goes from 1998 to 2025. The vertical axis is quantities in trillions of dollars. There are two time series, red and blue, and I'll explain each in turn. So let's focus first on the red time series. This is the assets or balance sheet space of the largest US financial intermediaries, the largest dealer banks. From 1998 to 2008, those balance sheets tripled in size, enormous growth. Why? Well, during that period, there was very light regulation. So the cost of expanding one's balance sheet with capital, in terms of capital requirements, was very light. Moreover, these banks were all viewed as too big to fail. It was generally conceded that creditors would not suffer much, if any, expected loss in the event of their near insolvency because the government or the Fed would swoop in and make sure that they didn't fail. Because of that, these banks were getting very cheap financing from the wholesale credit market, razor thin credit spreads. And that was like jet fuel for the growth of their balance sheets. They could borrow cheap, lend rich, or buy assets and expand their balance sheets in order to make every few basis points of profit that came their way. As we all know, in the financial crisis, those two problems, too big to fail and light capital regulation, were a root cause of the crisis and led to dramatic re-regulation of the market with higher capital requirements and with planning for how to resolve their failure without bailing them out. That increased the cost of expanding their balance sheets. And not surprisingly, those red bars did not grow very quickly after the great financial crisis. So the amount of balance sheet space is very limited now and growing slowly. Now let me turn to the blue bars. That's the amount of Treasury securities outstanding. So this is basically the size of the market that those dealers need to intermediate. Remember, they handle all of the investor flows in that market. So the blue bars are staying at or below the red bars until the financial crisis. And then they grow at an enormously faster pace after the financial crisis because of the huge US deficits coming out of that crisis and because of relatively loose deficit policy in the last few years. Going forward, the amount of Treasury securities is anticipated to grow at an even much faster pace, 3 trillion alone this year. Why? Well, because the government has appropriately decided to open up its fiscal space, use it to get out of the COVID crisis and spend a lot of money. Now, that may be appropriate, and it is appropriate for the current time period, but it does mean an enormous increase in the size of the US Treasury market. So if you compare the blue bars with the red bars, you can see we have a serious problem. The amount of Treasury securities to be intermediated is growing enormously quickly relative to the amount of balance sheet space for the dealers that intermediate this market. So when a whole bunch of large proportion of treasuries need to be sold and purchased in a short time, it all needs to flow through a relatively small pipeline of available balance sheet space. Let me make this even more dramatic. I've included in this chart the same diagram moving up to 2020. But going forward, I've used Congressional Budget Office projections of the amount of US Treasury securities outstanding through to the year 2050, 30 years from now. I've also allowed the red bars to grow at GDP growth rates, which I think is about as optimistic as one can be in terms of available balance sheet space. And you can see that this trend is simply not sustainable with the current market structure. It will be impossible in a future crisis, even a smaller one than we have today, for the red bars to be big enough to intermediate the flows coming from trades of the blue bar treasuries. So something needs to change in the market structure. And I'm going to come back to that later. I'm sure that you all have in mind something about not forcing all of the trades to go through the dealer balance sheets, but allowing some of the trades to go around the dealer balance sheets directly from an investor to another investor, like an insurance company selling to a hedge fund. I'm going to skip that slide in the interest of time and just talk about the size of the demands for liquidity. This slide illustrates the size of demands in terms of sales of treasuries, and this is only the foreign component because we know those numbers from the Treasury International Capital Systems data. The horizontal axis is the total amount of sales of US treasuries by foreign residents to US residents, essentially all of whom are US bank affiliated dealers. The vertical axis is the frequency by which a given level of sales occurred in terms of number of months. So for example, this histogram shows that since the year 2000, the typical monthly amount of foreign gross sales of treasuries is on the order of about $1.25 trillion. Now let's move across to the month of March of this year. I highlighted that number in red. $2.72 trillion of US treasuries were sold by foreign investors alone. And all of them had to be handled, essentially all of them had to be handled by those same US bank affiliated dealers, and they were just overwhelmed. They could not handle those flows because their balance sheets have a given capacity and it's not expandable at short notice. So what did the dealers do? Well, we're going to see in a minute. When they got those huge flows, I'm going to skip that slide, they increased their bid offer spreads, and that's an appropriate move by the dealers if you have a limited balance sheet and you need to cut down on the amount of trades that you're taking into your balance sheet. The natural thing to do is to increase your bid offer spread. That's the cost to the investor for trading, and as it goes up, it discourages trade. This is a chart that is in a speech. It's publicly available from the website of the Federal Reserve. The speech was given by Lori Logan the head of the open market trading desk of the Federal Reserve Bank of New York. The bid-offer spread on the vertical axis is indexed to 100 at the beginning of the year. And you can see that bid-offer spreads were normal until the end of February. And then bid-offer spreads went up by about a factor of 12 at the worst, and over 10 for an extended period of time. So basically, the dealers were telling their customers, we're only willing to take trades given the cost of available balance sheet space if you compensate us with extremely large amounts. It's just a standard kind of trade-off that the dealers were making. So investors faced with this increased cost of trade were basically stymied in their attempts to make trades. And the market was, as I said earlier, choking on the flows, could not handle the size of the flows. In that interdealer market where dealers trade with each other on a central limit order book called BrokerTech, you can see what happened. Again, there's strong evidence that the market became dysfunctional. Depth disappeared. Let me explain this slide. The vertical axis is the amount in millions of US Treasury securities offered for bid or sale within 3 ticks of the midpoint on the limit order book. So 175 million, which is the typical number leading into the end of February this year, was the amount that you could purchase, or alternatively, you could sell 175 million if you're willing to suffer a cost of 3 ticks on the limit order book. That amount of depth in the US Treasury interdealer market went from 175 million to under 10 million in New York, and similar plunges in depth occurred in London and in Tokyo for the US Treasury securities. So simply the ability to trade in that market disappeared. Nobody was offering liquidity or depth because everybody's balance sheet that was active in that market was stuffed. Simply no more space at the end. This is the volumes that were handled by the primary dealers. It is not the case that the large bank dealers said, sorry, we're not willing to handle the flows at all. They handled an enormous increase in flows. But once they got to a big enough amount, they increased their bid-offer spreads and stopped handling incremental amounts. And the dealers made a very large amount of money in this market. It's not that they pulled out of the market. They did a lot more, but they just got stuffed eventually. There's 2 time series in this. The green bars are the amounts handled by the dealers as reported by the dealers themselves to the Fed. And then beginning in March, by coincidence, we start to get data from Trace, which is the new transaction-based data set that is available to the government. The transaction level data are not available to those of us on this call yet, unless there's somebody here from the official sector. But we do know the aggregate amounts, and you can see that the interdealer market, which is shown in blue from Trace data, and the dealer to customer market, which is shown in red, are roughly balanced in size, although they vary somewhat through this period. Either way you look at it, enormous increases in flows, but the dealers could not handle more. I'm going to skip that slide in the interest of time and talk about what to do going forward. So this is going to take a little while again, and I trust that Jim is going to interrupt me if there are any urgent questions or if anybody wants to discuss something at this early point. Again, we're going to have a liberal amount of time. I'm hoping we're going to have a liberal amount of time to have a discussion once I go through these slides. Okay. Let me go back to where I started, which is with the market structure and how settlements are handled in this market. So this schematic is a schematic for how trades are settled. So if Jim is at JP Morgan, dealer 1, and Ross Starr is his customer at a hedge fund, Ross, when he trades with Jim, is going to settle that trade bilaterally, meaning that tomorrow Ross will deliver the securities and Jim will pay him in cash. Those bilateral settlements leave both Jim and Ross at risk of a failure of settlement due to one of them failing or being unable to come up with the Treasury securities in time. In the interdealer market, however, there is some amount of centrally cleared settlement. So CCP stands for Central Counterparty, which means that when Jim trades with, let me see, who should Jim's counterparty be? Let's say it's Terry Moore. I see Terry's watching. So when Jim trades with Jim at JP Morgan trades with Terry Moore at Goldman Sachs, if they trade in the interdealer market, at least for some of their trades, they will, instead of waiting until tomorrow to settle with each other, they will novate their trades to the Fixed Income Clearing Corporation, which is a counterparty for the Treasury market. And what that means is they don't need to face each other for another day. Their trades are guaranteed by this clearinghouse, which is backed by all of the resources of all of the large dealers and other market participants. So it's a much safer form of clearing. It reduces settlement risk. And here's the most relevant point for available dealer balance sheet space, it cuts down on the pipeline of positions that Jim and Terry need to handle. Because suppose Jim sold 100 billion to Terry and Jim purchased, let's say, 80 billion from Amanda Brennard. That means Jim has 180 billion, 100 here, 80 billion here, 180 billion of settlements that he's committed to until tomorrow. And that takes up space on his balance sheet. If, however, those two trades are centrally cleared, now Jim is committed to sell only 20 billion, the net of 100 minus 80, to the central counterparty. So the amount of space on Jim's balance sheet of these commitments to settle goes from 180 billion down to 20 billion, a factor of 9 decrease. Now that's an oversimplification. So likewise, Terry and Amanda may have long and short positions with different dealers, and they can also net down. The net effect is a significant reduction in dealer balance sheet necessary to clear the market. It's also a lot safer. The problem is, of all the transactions in the Treasury market that are going on now, it's estimated that only about 22% are centrally cleared. 78% are not. That's a concern because you've got a lot more settlement risk and a lot more balance sheet space tied up with settlement risk. When I looked at what happened in March and I thought about methods for mitigating the problems that we saw, including heightened settlement risk and excessive use of dealer balance sheet space, the first thing that came to mind is to increase the amount of central clearing in this market. Suppose that all large market participants were mandated by an official sector rule to centrally clear their positions at a central counterparty. If all of the trades are novated, or all of the largest trades are novated into a central counterparty, the market will be A, much safer, and B, much more efficient in terms of use of balance sheet space. My view is that this would be a dramatic improvement in the US Treasury market. And in the policy paper that I mentioned, or that Jim mentioned that I wrote earlier this year, I recommended that the official sector conduct a study of the costs and benefits of central clearing in this market. Now, lest you think that this would be an experiment on the scale that's never been tried, exactly what's illustrated in this diagram was mandated in the Dodd-Frank Act for US swap markets. And the amount of swaps that are centrally cleared has gone from under 10 trillion to about 100 trillion since the financial crisis. So a factor of 10 increase in central clearing. And no, it has not impaired the liquidity of that market. In fact, the bid-offer spread in that market has gone down by a factor of 10. It's much cheaper to trade in a swap market now. And part of that is related to the availability of central clearing. So safer and more efficient, reducing the need for dealer balance sheet space, and allowing, and this is a new element, allowing for the possibility of the blue dots to trade with each other. That is all-to-all trade as some component of the market. So some of these customers might continue to prefer to trade with dealers, but some of them, if there were central clearing, could trade directly with each other once an exchange sets up all-to-all trade. You can't have all-to-all trade in this market without a central counterparty. You can't get straight-through processing of central limit order book trade, nor anonymity of trades, nor electronic trading in general, unless you have a central counterparty. So this CCP is a prerequisite for all-to-all trade. And that, in my view, would significantly reduce the amount of balance sheet space needed, because now not every trade would need to even touch a dealer balance sheet space. Some fraction of trade could go directly from an ultimate seller to an ultimate buyer, a hedge fund to an insurance company, a pension fund to an asset manager. I'm watching the time carefully. I don't see any pending questions, so let me just finish up with a couple of remaining points, and then we'll open it up for general discussion. First, some might say, well, clearing a US Treasury security is much different than what we normally see in clearing for US security markets. For example, all equities are currently, all publicly traded equities are currently centrally cleared, but some might say, well, there's nothing like the US Treasury note. It's the largest volume trade in the world. Let's compare the one-day settlement risk for the US Treasury note with the one-day settlement risk for a very large equity security, the SPDR S&P 500 ETF, which is an equity that's centrally cleared on the NSCC, the National Securities Clearing Corporation. What's shown here is by time on the horizontal axis, including the March COVID events, the total amount of one-day settlement risk, that is the amount at risk if you don't settle, for the US Treasury note, the 10-year, which is the biggest one, and for the biggest equity security, the SPDR S&P 500. You can see that the market has already set up central clearing for equities in a way that includes securities with vastly greater one-day settlement risk than US Treasury notes. Actually, this understates it a bit because equities settle after 2 days. So there's 2 days worth of settlement risk for equities, and I've only shown 1 day's worth in the blue component on the blue line chart, which is one-day settlement risk for S&P 500 ETFs. So it is quite feasible to do this for the Treasury market. It's not too much. And I think I'm going to skip this last one. It's more plumbing oriented so that we can get directly to questions. I have a bunch more slides, Jim, that we can touch on if there is no questions, but I thought it might be more fun, at least for me, if you have some questions that you would like to ask, or you know of questions that some of the participants in this forum would like to ask. So I'm going to just stop right now.
Thanks very much, Darrell, for very interesting discussion.